Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, most people have seen the news lately and everyone is talking about inverted yield curves. Inverted yield curves are not normal and it's generally an indicator that something is probably wrong with our economy. So let's talk about inverted yield curves and what that does mean to investors.
Yeah, first off, Steve, let's just talk about what a yield curve is. And it sounds complicated, but really it's nothing more than a line showing current interest rates for various maturity periods of Treasury bonds in this case. Now, the yield curve can be a straight line, but it generally does slope upward from the lower left-hand corner of the chart to the upper right-hand corner. Now, discussion around the yield curve and the subsequent drama that it causes usually are about its shape. Yields on the curve should reflect risk, and because risk normally grows with time, longer-term investors should demand higher yields than shorter-term investors, which is why we see that upward slope, as you see on your screen right now for the yield curve 1 year ago, March 31st, 2021.
That's right, Travis. But now parts of the yield curve are inverted. At the end of March, we had the 3-year, 5-year, and 7-year Treasury yields all above the 10-year Treasury yield, as you can see on the screen right now. So the bond market, some would say, is potentially signaling a recession. Isn't that right?
That's true, Steve. However, the most scrutinized spread or pair of yields on the curve are the 2-year, 10-year spread. Now, people watch for inversion there, where the 2-year gets higher than the 10-year. And we did have the 2-year creep higher than the 10-year for a brief moment recently, but it was short-lived. Now, people watch this indicator because when the 2s get higher than the 10s, or you get a 2-10 inversion, that has preceded 10 of the previous 13 recessions, so it's viewed as a reliable indicator.
And Travis, it isn't that simple though, is it?
No.
As you said, this particular inversion was brief, and it hasn't been persistent, at least not yet. Mm-mm. And recessions following inversions get even more complicated because the recessions that have taken place after an inversion you talked about have happened anywhere between just a few months and up to 2 years after the inversion. Mm-hmm. So predicting when a recession is going to happen generally isn't a productive exercise, is it?
No, Steve, it's not. And a less productive exercise is trying to predict how the market's going to react to the market predicting a recession down the road. So let's summarize some points here we talked about. Yield curve inversions are a warning sign for the economy. Currently, we've got high inflation and a tightening Fed. Inversions generally precede recessions, but the time frame isn't predictable, as you pointed out. Could be a few months, could be a couple years. Good luck picking what's what there. And then, last, I would say your advisor should know that recessions are a normal part of an economic cycle, and they should help you broadly diversify according to your risk profile. Everyone's different. And that will help you or put you in a position to weather these storms, instead of trying to predict when things might happen and so forth.
That's absolutely right. Travis, this has been great. I look forward to it next week.
Look forward to it as well. Thank you for watching this week's Exchange.
To make sure you don't miss out on future discussions, please follow us on social media.
Make sure to like and share our videos, and we'll see you next week.